This is Nightly Business Report with Bill Griffith and Sue Herrera.
Volatility returns. This week tested investors' nerves. But it's not totally clear why stocks moved sharply higher one day, only to tank the next.
Priced out. As interest rates rise, the American dream of homeownership moves out of reach.
Think big. The Mega Millions jackpot hits $1 billion, a number that's pretty hard to grasp and wrap your head around. Those stories and more tonight on Nightly Business Report for Friday, October 19th.
And we bid you good evening, everybody. Welcome. Investors got a wake-up call of sorts this week. Volatility did return with big intraday swings and choppy trading sessions. What was peculiar, though, about this week was the news didn't change much from day to day, but that didn't stop the market from rising and falling sharply. And today was no different. In the end, the major indexes finished the day mixed, with the Dow gaining 64 points. It's at 25,444 after sliding more than 320 points yesterday. The Nasdaq was down 36. The S&P fell 1. And for the week, after all the wild swings, we only saw fractional gains and losses, and they certainly don't tell the whole story.
A choppy week, marked by continuing rising geopolitical tensions between the U.S. and Saudi Arabia and concerns about the Chinese economy and an Italian budget crisis. All of it had investors wondering if the U.S. economy could stay as strong as it looks now.
The market struggled all day, moving between gains and losses.
On Monday, the Dow ended down 89 points. Then strong earnings from a broad swath of tech, healthcare, and financial companies set the stage for a relief rally on Tuesday and the week's biggest move, a gain of 547 points. But the relief was brief.
The Federal Reserve hints at more rate hikes.
On Wednesday, minutes from a recent Fed meeting confirmed beliefs that another interest rate hike is coming in December. The Dow dropped more than 300 points early on before finishing down 91. Adding to the global plate of worries on Thursday, China's economic slowdown and European Central Bank leader Mario Draghi, who worried out loud about EU members spending beyond their means. The Dow dropped 327 points. And today, another bumpy ride. A gain of more than 200 points disappeared, but the Dow bounced back again and finished up 64. In many ways, the wild ride traces back to last week's two-day loss of more than 1,300 Dow points. Since then, a lot of bumps.
And the question investors want to know is whether this bumpy ride will continue. Mike Santoli digs into that.
The stock market has hit some turbulence in October with daily swings of at least 1% in 5 of the past 7 days and its sharpest drop in 8 months. So is this just another test of the market's resilience or the first phase of a tailspin into a deeper, longer-lasting correction of the sort that investors endured early this year and before that in late 2015? Traders are now dissecting the day-to-day gyrations for clues. For the moment, the market lows set a week ago on Thursday on the S&P 500, that was down 7% from its record high of a month ago, have held up. And the jumpy rallies and sell-offs that have followed are fairly typical of a market trying to steady itself after a swift setback. Longtime Wall Street wisdom holds that a good market bottom is often retested over the course of days or weeks to see whether bargain-hunting investors again step in at those prices. This is exactly the pattern that unfolded between February and April of this year. The optimistic take on the recent action says it's simply a choppy adjustment to higher interest rates, global market weakness, and the flagging leadership of big tech stocks, rather than the stirrings of a more drastic downturn. Earnings are generally coming through quite strong for a third straight quarter, and seasonal patterns tend to turn positive from about this time in October through the end of the year. But the age of this economic expansion and concerns about its eventual end have become more pervasive in recent weeks. The effect of tax cuts and fiscal spending hikes will wane next year, and the Federal Reserve seems intent on lifting interest rates another 3 times or so in 2019, despite risks of slowing growth. Meantime, trade conflict has dropped China's stock market into a bear market, and European markets are all down more than 10% from their highs. The way these cross currents play out in the coming weeks will determine whether any further weakness in U.S. stocks is a simple retest of buyers' resolve or a relapse into something more painful. For Nightly Business Report, I'm Mike Santoli.
Now, one theory that tries to explain the recent volatility is that it has been driven by computers and sophisticated algorithms. That was one of the explanations offered yesterday by David Solomon. He's the new CEO at Goldman Sachs.
The growth of passive product, index product, ETF, the growth of systematic trading, and also, machines more involved in what we do, all those things are untested over any duration of time with severe stress. Now, when we see a little bit of stress, you can see reactions that might lead you to believe that there's a risk that with more significant stress, that could play a bigger role. But I wouldn't predict that, but it's certainly something we watch. And there's no question, when you look at last week, some of the selling is the result of programmatic selling, because as volatility goes up, some of these algorithms force people to sell.
Well, let's turn now to our friend Kenny Polcari. He's director of the New York Stock Exchange floor division at O'Neill Securities to talk about computerized trading and so forth. Kenny P., nice to see you, my friend.
And you.
So there were times this week, I have to admit, when we were scrambling to come up with a reason for an intraday swing, whether it was up or down. How much of it do you think is pre-programmed computerized trading right now?
A lot of it is pre-programmed at this moment, because what you have to understand is what happened last week, right? As rates shot up, as the market was ill-prepared for that really surge in rates, then you had this sell-off. The sell-off produced a lot of internal damage, and internal damage meaning to the broader market as well as to individual names, and that damage exacerbated by the speed at which the markets and individual stocks can trade because of the automation.
Right.
The automation is one. The market fragmentation is the other. Remember, the New York Stock Exchange is no longer the central marketplace. There are 10 exchanges and 40-plus alternative venues where people can buy and sell stocks. And so, therefore, it's a fragmented marketplace, which also adds then to the volatility.
And for the average long-term investor, Kenny, what do they need to look at in a week like this, where you see these violent swings and they wonder, should they sell or not? Can you give them a nugget of advice as to when they have to pull the trigger, given the automation that we have?
Sure, I'd love to. So here's the deal, right? If you're a long-term investor and you've got a well-thought-out plan, and the stocks that are in your portfolio are ones that have a good story, they're strong, you stay on top of it, you make sure that that story has not changed, and then when moves like this happen and the broader market gets hit, for whatever reason, whether it's talk of interest rates, whether it's surging interest rates that all of a sudden cause a sell-off, the stocks that you have that are in your portfolio that are good names with a good story, those are stocks, when they go on sale, the way that we saw, are stocks that you should consider adding positions to or putting more money to work in. The last thing you should do is run out the door on that, unless, of course, the story on that particular stock has changed. If it's changed, then that's a different story.
Right.
But if it hasn't changed and the stock goes on sale, then that should be an opportunity for the long-term investor to put more money to work. The long-term investor should not listen to the daily noise, right? The noise that's created by this automation. They need to learn to eliminate that.
Before you go, I think it's important to note very quickly that, I can hear Larry Kudlow or Jack Bogle saying that in the long run, it's earnings that matter to the stock market and prices. And you're right, the short-term swings is just noise, right?
And the short-term swings, like in this case, is being created by not only the surge in interest rates, but some of the geopolitical issues, right? What's happening in Saudi Arabia, what's happening, down in D.C. and all that stuff. Although it creates short-term noise, does not in the long term price stocks.
Sounds like you had a busy week with the voice there, I can tell.
I did.
Kenny Polcari with O'Neill Securities. Always good to see you. Thanks for joining us tonight.
You as well. Yeah, bye-bye.
And a Federal Reserve official is adding another item to the list of risks to the market. According to Reuters, the president of the Atlanta Fed said the case of missing journalist Jamal Khashoggi is being monitored because it might lead to sanctions that could disrupt the oil markets. Raphael Bostic is believed to be the first central banker to comment on that case. Today, the price of domestic crude climbed, although it was down overall for the week.
Well, China's economic growth is slowing. The world's second largest economy today reported its slowest quarterly growth in nearly a decade, and some global companies are starting to feel the effects as well. Seema Modi explains.
China's economy is cooling down just as U.S.-China trade tensions heat up. Chinese officials blamed external factors like higher rates and trade frictions for the drop in growth. China's central bank followed with new measures to boost its economy, an attempt to ease investor concern about growth stalling. The slowdown in the world's second-largest economy is ratcheting up financial pressure on companies that do business there.
Truth is, it's slowing. And it's really masking, I think, a much bigger problem that's developing. The owners of businesses that I know and investors in China are deciding that the trade war with the U.S. is morphing into a longer-term Cold War of sorts, and that it's not going to go away when the tariffs go away, if they do.
This morning, French tire maker Michelin warned of a slowdown, citing weak demand from China. It comes after luxury conglomerate LVMH last week reported a drop in sales from Chinese shoppers, a concerning sign as China is a key growth market for high-end fashion retailers. Analysts at Oxford Economics say a string of disappointing data over the past month from China suggests a broader-based slowdown is now emerging. Inconvenient timing as tensions between the United States and China continue to intensify. For Nightly Business Report, Seema Modi.
And from China to Europe, European Union officials continue to spar with Italy over its budget. Investors around the world are watching to see how this is going to play out, even as the EU's budget chief tries to calm concerns that Italy's financial problems could spread. Willem Marx is in Brussels for us tonight.
Yesterday, both the ECB President Mario Draghi and the European Commissioner for Economic Affairs Pierre Moscovici had strong words of warning for Italy's new government and its future spending plans. Draghi said Eurozone countries, including Italy, must follow budgetary rules, while Moscovici expressed, quote, serious concerns about Italy's draft budget that was submitted to the EU at the start of the week. Senior politicians in Rome did not react kindly to the criticism. One Deputy Prime Minister, Luigi Di Maio, said bureaucrats here in Brussels should stop, quote, pontificating and instead find out what ordinary Italians really want. His far-right counterpart in Italy's coalition, Matteo Salvini, said the European warning simply showed Italy was in the right. Today, still in Rome, Commissioner Moscovici has insisted the EU has no intention of interfering in Italy's economic affairs, but the bad blood is unlikely to end anytime soon. Italy must formally respond to his concerns by Monday, and in the meantime today, Italian 10-year bond yields hit a 4-year high, the country's stock market touched a 20-month low, and bank stocks in particular took a hammering. For Nightly Business Report, I'm Willem Marx in Brussels, Belgium.
Time to take a look now at some of today's upgrades and downgrades. We begin with Disney tonight. It was upgraded to overweight from equal weight at Barclays. The analyst cited the company's focus on streaming and its potential for growth in that area. The price target $130. Shares of Disney rose 2% to $118.90 today. Ford was downgraded to equal weight from overweight at Morgan Stanley. The analyst cited limited progress from the automaker's restructuring and said that its dividend may be at risk. Price target $10. That stock fell a fraction to $8.50.
eBay was downgraded to hold from buy at Stifel Nicolaus. The analyst says PayPal's earnings release yesterday suggests weaker sales trends at eBay in the third quarter. The price target is $35. The stock dropped more than 8% to $28.75. Apple is rated outperform in new coverage at Wedbush Securities. The analyst there sees strong iPhone demand and cites that company's growing services business.
Services, we think that business alone is about $500 billion, about call it $450 billion. And I think that's really what the street now is starting to reanalyze that, and the multiple continues to expand.
And the price target is $310. That is the highest on Wall Street. Shares rose 1.5% to $219.31.
Still ahead, stock surge. The Dow component that proved its doubters wrong, at least for today. The Treasury Department today unveiled new rules for investors looking to finance development in underserved communities. In return, those investors would receive significant tax breaks. The proposal would govern investments in so-called opportunity zones. These were created by last year's new tax law. Treasury officials expect as much as $100 billion in private capital to be funneled into those areas.
Existing home sales fell by the most in more than 2 years. The National Association of Realtors says that sales dropped 3.4% last month as a combination of higher prices and rising mortgage rates made homes less affordable. And for those already in the process of buying a home, the rise in rates is changing their plans. Diana Olick has our story.
Scott and Natasha Richardson signed a contract on a newly built home in Austin, Texas at the start of this year when interest rates were low.
One of the things that was, that we considered was where the interest rates were going because of what we heard about everything, possibly going up in the future. And that's one of the reasons we took the step when we did. And now we're in a very different place, even just 8 months later.
Because construction is taking longer than expected and the rate they locked in long ago expired. Now, with rates a full percentage point higher than they were at the start of the year, they are looking at a whole new set of numbers.
We don't anticipate it being a problem getting another loan, but at the same time, it definitely doesn't feel as a solid foundation as it did when we had it already approved.
While Scott and Natasha will still buy the home, they will likely dial back on the amenities like electronics and higher-end appliances.
There's just a lot of kind of uncertainty as to what we'll be able to afford by the time we finally lock in an interest rate.
And we thought we had a plan, but now it's a little we're just really nervous.
For others, though, higher rates could knock them out of home ownership entirely. The Richardson's agent, B. Barnett, says some of her buyers have decided to wait, and so have some of her sellers.
I have several customers who have decided to lease their properties right now instead of sell because they're afraid with those raising interest rates that they won't be able to get the same market value they once did earlier this year.
Other sellers are staying put because they don't want to move and lose their current low mortgage rate. Moving up to a better home now also means moving up to a higher rate. For Nightly Business Report, I'm Diana Olick in Washington.
To earnings now, in Procter & Gamble's very big day, the Dow component reported its strongest sales growth in 5 years and said that it is raising prices on a handful of products, and that sent shares up the most in a decade. Sarah Eisen takes a look at P&G's better-than-expected results.
Investors cheering Procter & Gamble's best sales growth in 5 years. CEO David Taylor said when it comes to the improvement that they are seeing, it is broad and it is global.
Yes, a lot did come together in terms of the absolute top line growth, but what you've seen is trends. 3 months ago, 6 months ago, you saw North America, U.S. rather, start to turn positive, and now we're positive on share on past 1, 3, 6 months. You've seen the sequential improvement in China. We're now at sequential improvement in our Latin America business. We're starting to overcome some of the very significant headwinds in the Middle East. We're making very good sequential progress on India, but it's really focused on superiority of the brands across the elements we've talked, and the productivity has helped us offset what has been a very difficult external environment.
The takeaway? This quarter is a reflection of both a better global economy, especially in the United States, and P&G's turnaround strategy starting to bear fruit. That explains the growth that the company saw in its beauty business, home care, and even grooming, which had been doing poorly lately. Shedding brands, streamlining decision-making by geographies and specific products, just some of the moves Taylor has made over the last years to get P&G growing again. Now, despite this momentum, the company did keep its long-term outlook intact, saying it expects to grow 2 to 3% organic sales this year. Taylor told me they're being conservative because the macroeconomic environment globally is challenging. That has hurt P&G in the form of a stronger U.S. dollar and higher commodity costs, which are putting pressure on their input costs. They're also passing those higher prices onto the consumer, something that's going to impact spending over the next few quarters. For Nightly Business Report, I'm Sarah Eisen.
The denim business is fading at VF Corp, and that's where we begin tonight's market focus. The owner of Wrangler and Lee Jeans issued a bleak forecast for its jeans business and reported slow sales at some of its outdoor brands, including Timberland. That offset overall quarterly results that were stronger than expected. The stock tumbled more than 10% to $77.76. The SEC has opened an investigation into Honeywell's accounting. The company says it is cooperating with the probe. Separately, Honeywell reported better than expected earnings and revenue in the most recent quarter, but warned that the ongoing trade war between the U.S. and China will pressure its margins in 2019, potentially costing it hundreds of millions of dollars. The stock fell 1% to $153.47.
Trade concerns have apparently eased at Kansas City Southern. The railroad operator said today it supports the reworked trade agreement between the U.S., Canada, and Mexico, and added that steel and aluminum tariffs still need to be worked through, as the CEO put it. The company also reported a 30% increase in profit for the most recent quarter. Shares rose more than 3% to 106.12 today. And it is not often that a CEO belittles Wall Street analysts and investors during the company's earnings conference call, but that's exactly what happened today when the head of Cleveland Cliffs said that analysts can't read numbers, his words. He also went after one unnamed person with jarring language.
You are a disaster. You are an embarrassment to your parents. With this being said, we are going to use money to reward the long-term shareholders. So if the stock continues to go down based on these kids that play with computers and somebody else's money, we are going to buy back stock. We are going to screw these guys so badly that I don't believe that they will be able to only resign. They will have to commit suicide.
Well, the mining company's stock has been heavily shorted, and shares today fell more than 3% to $11.05, despite reporting an increase in profits and improved revenue. Clearly, that is what upset the company's CEO today.
Now to our weekly market monitor, who says he's finding opportunity in undervalued small-cap tech stocks right now. He is Jay Kaplan, co-portfolio manager of the Royce Dividend Value Fund. Welcome. Nice to have you here.
Thanks. Good to be here.
I can't wait to get some of these names out. Insight Enterprises is your first pick. Why do you like it?
They sell all technology, hardware, and software to everybody, so they're agnostic about the winners and products. There's more cyber, there's more cloud, there's more services. The stock sells 11 times earnings, with the Russell selling at 25 times earnings, and we think the growth is there for a couple of years. Should be really good.
Vishay Intertechnology. Now, this is a specialized semiconductor company. You're a dividend fund. You like the dividend on this one, among other things, right?
It's almost a 2% yield. They sell passive components. There's a worldwide shortage of capacitors right now, and as autos get more electronic, there'll be more of these in cars. This problem's not going to be solved till well into 2019, so that's really good for business. So
my car's going to get even smarter?
Much
it's already smarter than me.
It's going to be crazy.
Let's turn to Electro Scientific Industries. Trades at about 7 times earnings.
Yeah, it's a turnaround with new management. They make laser-based machines that drill holes thinner than a human hair. So the connectors inside your cell phone, itty-bitty holes. Business is down right now, but business should be really, really good over the next few years. And at 7 times earnings, I think it's good for a long-term holder.
So much of the interest, of course, has been with the big technology companies, the so-called FANG stocks.
Yes.
Why do you look to small caps?
Well, first of all, at Royce, we're small cap investors, number one, so that kind of helps. But when you're away from the news flow and you can really think about company fundamentals and great valuations without the noise, and you have a long-term holding period that's more than a week or a couple of months, 3 to 5 years, you can find great companies that are going to do very well for you over the long period of time.
As you point out very quickly, a number of them also pay a fairly decent dividend, so you get paid while you wait.
We love dividends. Dividend-performing stocks in the Russell over time have outperformed non-dividend payers.
Thank you so much, Jay. Nice to have you here tonight.
Thank you, guys.
Jay Kaplan with the Royce Dividend Value Fund. And to read more about Jay's picks, you can head to our website, nbr.com. Coming up, the Mega Millions jackpot hit a record. But what's $1 billion really worth? The Mega Millions jackpot hits $1 billion, the largest ever. But can you really grasp what $1 billion is worth? Frank Holland asked around in Hackensack, New Jersey.
Wish me luck. 1 billion reasons to play the Mega Millions today. People across the country dreaming about the 10-digit jackpot, despite long odds, 1 in 302 million.
Me and my wife, we'd be all over the world. Take a trip here and there, invest, things that you do when you win that kind of money?
I think it motivates you more because it's so much money. You think, why not just take a chance? It's only $1 or $2.
Before taxes, the winner would have twice the net worth of LeBron James, Taylor Swift, and George Clooney. Also, a bank account bigger than the gross domestic product of island nations Samoa, St. Kitts and Nevis, and Tonga. But most winners take the lump sum payment. For this drawing, it's $565.5 million, and even the winner won't be lucky enough to escape their tax bill. If you estimate at least 30% going to Uncle Sam and the state, that leaves about $396 million. A pretty good return on investment for a $2 ticket.
Yes, for $2, you can't beat that. You can't beat that. I mean, that's a chance you take in a lifetime.
If no one wins Friday night's drawing, it would roll over to $1.6 billion, a new U.S. record, and it could grow even higher, depending on how many more people play. For Nightly Business Report, Frank Holland in Hackensack, New Jersey.
Finally tonight, October 19th, 1987. Ring a bell? Remember Black Monday? It was 31 years ago today when the Dow plummeted by 22%. Still the largest single-day percentage crash in U.S. history. Point-wise, the Dow fell 507 points that day. Now, if the same percentage decline were to happen today, it would amount to a decline of 5,700 points. But as we know, circuit breakers have since been created to try to prevent declines like that from happening again, at least not without pauses during the day to let things settle down.
I don't think either one of us will forget that day.
We remember it very, very well.
Indeed. Before we go, here's a look at the final day's numbers on Wall Street. The Dow gained 64 points. The Nasdaq was down 36. The S&P 500 fell 1. And for the week, after all those wild swings, we saw only fractional gains and losses. But there's always next week.
Yes, there is.
That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great weekend. See you Monday.